In this video, we're going to start with chapter 16, and I want to introduce the cash flow statement to you. And as the cash flow statement is named, it really deals with the cash of a company. So I want to start off with a simple exercise. I want you to look at these two companies, and I purposely did not include the names, Company 1 and Company 2, right? And I want you to look at the numbers for Company 1 and 2, and I want you to pause the video and I want you to answer these four questions related to Company 1 and Company 2. So here's the net income for Company 1. This is in brackets, so this is a $241 million loss. This is a $274 million profit. Then you have a $39 million loss. Then you have a $596 million profit. And then Company 2, you've got $129 million, then $162 million, and then $208 million, and then $233 million, right? So what company do you think, what do you think about both companies, just looking at these numbers? Which company would be a better investment if you had to choose? Which company would you want to do business with? And if you were an employee of Company 1 or Company 2, would you be concerned, right? All right, so just take a minute, pause the video, and answer these questions. So hopefully you did that. So usually when I ask these questions in a class, these are the answers that I get. So first, people say, well, look, yeah, obviously that they prefer Company 2 is more stable than Company 1. If you look at Company 2, you have earnings in net income, which is profit, increasing every year. Whereas Company 1, it has a loss, then it has income, then it has a loss, then it has income. So it's fluctuating. So which company would be the better investment? If you looked at these two numbers, most of the class always picks Company 2. Absolutely. They say Company 2. Which one would you do business with, right? Of course, Company 2, right? I mean, if you had a choice to do business with one of these, which one? And if you were an employee of Company 1 or 2, would you be concerned? Well, you would be concerned if you were a employee of Company 1, right? So if you're an employee of Company 1, you would be concerned because of the fluctuating earnings, right? And you may actually, if you got an offer from Company 2, you may decide, you know what, let me move from Company 1 to Company 2. Okay? So when we look at the net income numbers for these companies, this is what we show. All right, so now we're going to look at scenario 2. We're going to keep the same company, but instead of only showing you the net income numbers, we're going to show you the cash flow from operation numbers, which is the cash flow information from the cash flow statement, which you haven't learned yet, which you're about to learn, okay? So let's take a look at this. So now look at these two companies again, same companies, but now we have the net income numbers, but now we have the cash flow from operation numbers, and watch the difference, the complete difference in the picture that is painted. So look at Company 1, 241 million, but 6.8 billion in cash flow from operations, right? And this is how much cash is generated from selling goods and services. This is how much cash is generated from selling goods and services. Company 1, 274 million, 5.5 billion. So basically we've got 6 billion, 5 billion, 4 billion, 12 billion, 17 billion, 18.4 billion. And look at Company 2, 200 million, 120 million, 219 million, 15 million. Okay, it's 364 million and 234 million, right? And so now when I add this piece of information, cash flow from operations, and I re-ask these questions, well, what do you think about both companies? Suddenly, right, people say, well, Company 1 is more stable, right? So Company 1 looks better. And then which company would you want to invest in? Well, most people say Company 1. Some people still say Company 2, but most people change to Company 1. Which would you rather do business with? Well, some people say absolutely Company 1. And which one would you be more concerned with? Or which one would you feel safer with as a company? They would go back to Company 1. They would say, well, Company 1 is better as an employee. And I like to bring this up because if you only look at net income, right? And remember, you will probably remember from the beginning of the course, we talked about net income. Net income tells you, here's what I sold my goods for, and here's how much it cost me to produce those goods. I take the difference, and if it's positive, then I have profit. If it's negative, I have a loss, okay? So the net income number doesn't tell me anything about how much cash I actually receive from generating goods and providing services. the cash flow from operations does. The cash flow from operations tells you this is how much cash this company generated from providing goods and selling goods and providing services. So this is how much cash was generated. And if we look at these two companies, it's like a huge difference between company one and company two. So if you just look at net income alone, then one company looks great, but if you look at net income and cash flow from operations, it paints a completely different picture of these two companies, which is why only looking at the income statement and the balance sheet and the statement of equity by itself is not good enough. When you're examining or investing in a company, you also have to look at the cash flow statement. The cash flow statement is very, very important. So who are these two companies? Well, company one is Amazon, and company two is Under Armour. And if you look at the rise in Amazon stock price over the last couple of years, you'll see Amazon is doing really well, right? And there are many different reasons, sort of outside of the scope of this class, as to why there's these different numbers in cash flow from operations. Amazon operates in a retail sector, and they have a very interesting business model that you should sort of study in some of your classes. But in company one, Amazon, and company two, Under Armour. Okay, so those are the two different companies. So the point of this introduction is that without the cash flow statement, you have an incomplete picture of what a company's financials look like. So it's not enough to look at the income statement, statement of equity, and balance sheet. You also need to look at the cash flow statement.